All right, so let's uh, let's dive into this Macro Butler newsletter this month.
Yeah, December 2024.
December 2024. And you know,
Things are getting interesting,
interesting to say the
to
least.
say the least, yeah.
This newsletter really digs into, where we might be headed with the economy, and
It does.
frankly, some of it's a little unsettling.
Yeah, a little bit.
But you're a savvy investor, and uh, forewarned is forearmed, right?
Right.
So today we're going to break down some of those key takeaways,
Absolutely.
the things that you need to know to navigate the year ahead,
Yeah.
and maybe even potentially profit from the chaos.
It certainly seems like the Macro Butler is sending up some flares this month.
Definitely. And they're starting with this whole unemployment puzzle thing.
Yeah.
On the one hand, we saw more jobs added in November than expected.
Right.
Sounds good, right?
Well, not so fast. The devil's in the details. A lot of that job growth was concentrated in sectors like education, healthcare, government, not exactly known for driving huge profits.
And that's not all. The unemployment rate actually ticked up to 4.2%.
Mm-hmm.
That's been hovering above its two-year average for a while now, since August 2023 to be exact.
Right, and that's the part that makes me raise an eyebrow historically when that happens.
Yeah.
It often signals a broader economic shift and not for the better. It's like a canary in a coal mine.
So are we saying the economy is about to keel over?
Not necessarily, but it's definitely something to watch closely,
Yeah.
especially when you consider what the Macro Butler says about retail sales.
Yeah, at first glance, those numbers look pretty good, up 0.7%.
Uh-huh.
But then they hit us with the inflation caveat.
Right, that 0.7% figure isn't adjusted for inflation. Once you factor that in, the growth picture isn't nearly as rosy.
Yeah,
A lot of that spending seems to be fueled by what they call the wealth effect.
right.
People feeling flush because the stock market is doing well, but is that sustainable?
Good question, especially if the market takes a hit. And speaking of things that could take a hit,
Yeah.
the newsletter is also predicting more reflation.
Reflation, yeah, it's basically like inflation's annoying cousin who keeps showing up uninvited.
Hmm.
And the Macro Butler thinks incoming policies, things like import tariffs and tighter immigration, are going to make it even worse.
Makes sense. Tariffs mean higher prices on imported goods, and fewer workers mean businesses have to pay more for labor, which they then pass on to consumers.
Exactly.
Ouch.
It's a bit of a vicious cycle, and it puts the Fed in a real bind,
Yeah.
which the Macro Butler calls the Fed's dilemma.
Right. The Fed just lowered an interest rates,
Okay.
but the Macro Butler calls it an irrelevant hawkish cut.
Yeah,
That sounds like an oxymoron.
it does, doesn't it? Cutting rates is usually meant to stimulate the economy, a dovish move.
Right.
But it seems the Fed is still worried about inflation.
Right.
Hence the hawkish part of the equation. Even their own projections are now showing higher inflation and unemployment down the road.
Some Fed officials are already sweating the impact of potential policies
I know, it's crazy.
before they've even been enacted.
Yeah.
The dot plot, which is basically, a chart that shows where each Fed official thinks interest rates are headed, is starting to lean towards fewer cuts and maybe even hikes in 2025.
Yeah, it's like they're tapping the brakes with one foot while still hitting the gas with the other. A confusing signal for sure.
And then there's this Taylor rule,
Uh-huh.
which basically says that interest rates should be way higher than they are currently,
Right.
around 6%.
Yeah, like 6% compared to the actual 4.5%.
Yeah.
That discrepancy suggests the Fed might be behind the curve when it comes to tackling inflation.
Hmm.
It paints a picture of a central bank caught between a rock and a hard place.
So we've got a potential jobs.
Yeah.
Slowdown inflation is munching away at our purchasing power,
Right.
and the Fed is sending mixed signals. Is there any good news in this newsletter?
Well, the Macro Butler does throw in some historical context that might be helpful, though it's not exactly cheerful.
Okay, you're talking about the S&P 500 to gold ratio, right?
Yes, that's the one.
They say when that falls below its 7-year moving average,
Uh-huh.
bad things tend to happen.
Exactly. It often precedes a similar drop in the S&P 500 to oil ratio, which historically signals a shift toward an economic bust.
Right.
These ratios are essentially measuring investor confidence.
So when those ratios start falling, it's like investors are saying, Houston, we have a problem.
Pretty much, they're getting nervous and starting to flock to safe havens like gold, which tends to hold its value when the market gets shaky.
Okay, that makes sense. So if those ratios are flashing red, what does that mean for other types of investments, like bonds?
That's where things get even more interesting, which we'll discuss in a bit. Let's first unpack why this is all relevant to you. The Macro Butler suggests all these warning signs point to higher bond yields, which is particularly concerning for long-duration bonds.
Why is that? I thought higher yields meant a better return.
That's true in a vacuum, but in this case, it's more of a red flag. Remember, bonds are essentially loans to the government.
Right.
When bond yields go up, it means the government has to pay more to borrow money, and that, my friend, is bad news for banks.
Hold on. How are rising bond yields connected to banks?
Banks hold a lot of government debt,
Yeah.
so when those yields go up,
Yeah.
the value of their bond holdings goes down.
Hmm.
It's like finding out your retirement fund just took a hit.
And to make matters worse, the U.S. government has a ton of debt that needs to be refinanced in 2025.
Yeah, a mountain of it.
If yields keep climbing, it's going to cost them a fortune.
Exactly. It's a recipe for economic instability.
Yeah.
And that's not even factoring in the impact on mortgage rates.
Right. They mentioned that even with the Fed cutting interest rates, mortgage rates might not budge much because banks are tightening their lending standards.
That's right. Banks are getting spooked by all this uncertainty.
Hmm.
So even though the Fed is trying to make borrowing cheaper, it might not translate into lower mortgage rates for consumers. And that could put a damper on the housing market and overall consumer spending.
Okay, so bonds are looking risky. The housing market might be in for a rough ride.
Yeah.
Anything else we should be worried about?
Well, the Macro Butler has some interesting thoughts on the U.S. dollar and gold.
Let's hear it.
They're predicting a stronger dollar driven by those import tariffs we talked about, and general global uncertainty. A stronger dollar usually means it buys more of other currencies.
Makes sense, but isn't that a good thing?
It can be, but there's a twist.
Okay.
While the dollar might flex its muscles against other currencies, the Macro Butler thinks it will weaken against gold.
Now that's counterintuitive. If the dollar's getting stronger overall, why would it weaken against gold?
Because gold is like the ultimate safe haven asset.
Oh.
When things get dicey in the economy, people flock to gold.
Yeah.
It's seen as a store of value that's less susceptible to the whims of governments and central banks.
So even if the dollar is strong against, say, the euro or the yen, it could still lose ground to gold if investors are worried about a recession.
Precisely. And all signs point to those worries being very real.
This is all painting a pretty bleak picture. Is there any light at the end of the tunnel?
The Macro Butler does offer some potential strategies for navigating this turbulent landscape. They call it thriving in the face of stagflation.
Catchy.
Catchy! Right.
I'll admit they have a way with words, so what's their secret sauce?
Well, they start by acknowledging the elephant in the room.
Okay.
The U.S. is still technically in an inflationary boom.
Right.
But those warning signs we've been discussing are flashing bright red.
Yeah, they even use the term inflationary bust, which sounds like a really bad sequel to an already terrible movie.
It's essentially the same thing as stagflation, that nasty combination of high inflation and low economic growth we talked about earlier.
It's the 1970s all over again. Not exactly a fun time.
Not at all. But the Macro Butler suggests that in this kind of environment, certain assets will actually thrive. They call them anti-fragile, meaning they not only survive chaos, but actually benefit from it.
Okay, I'm intrigued. Which assets are we talking about here?
Gold, for one, as we discussed, it tends to shine when the economy is shaky.
Yeah.
But they also highlight hard assets like commodities.
So things like oil, copper, agricultural products. Why would those do well in a stagflation scenario?
Think about it. If inflation is high, the value of paper money erodes.
Right.
But the stuff that those commodities represent, the actual physical goods, become more valuable.
So while bonds and other traditional investments might suffer during stagflation, gold and commodities could potentially act as a hedge.
That's the idea. They become a safe haven in a storm.
This is all a lot to process. What are the key takeaways you think our listeners should focus on? So if the Macro Butler is right and we're headed for this inflationary bust, how should our listener be thinking about their portfolio?
Well, it definitely challenges the traditional buy and hold approach that a lot of investors rely on.
So are you saying we should all be ditching our stocks and bonds and loading up on gold bars and barrels of oil?
Not necessarily. It's not about making drastic moves, but rather about being more strategic and diversifying beyond those traditional assets. Think of it as building a portfolio that can weather different economic storms.
Right. Don't put all your eggs in one basket. But even beyond specific investment advice, I think this newsletter underscores the importance of staying informed and thinking critically about the bigger picture.
Absolutely. The Macro Butler provides one perspective, but it's crucial to continue learning, seek out different viewpoints, and not just follow the crowd.
And speaking of different viewpoints, they leave us with a rather provocative thought, the potential for a Trump stagflation. What do you make of that?
It's certainly food for thought. They don't delve too deep into what that would look like, but it implies a scenario where those protectionist policies we discussed, tariffs, tighter immigration, could exacerbate the inflationary pressures we're already seeing.
And if you combine that with the other factors we discussed, the potential for a job slowdown rising bond yields the Fed's tricky balancing act. It creates a pretty complex and uncertain economic landscape.
The million-dollar question then becomes, how do you as an investor not just survive, but thrive in that kind of environment?
That's a question each listener will have to grapple with on their own. But we've given them some valuable tools and insights to start that process.
Exactly. Knowledge is power, especially when it comes to navigating the markets. The more you understand about these economic forces, the better equipped you'll be to make informed decisions for your financial future.
So to our listener out there, don't just take the Macro Butler's word for it. Do your own research, consider different perspectives, and remember that the best investment you can make is in your own financial education.
Well said. Stay curious, keep learning, and until next time, happy investing.